we are going to discuss some very important numericals, and based on that we are going to understand very important concepts. So whatever those questions we are including in this series of the session, that all are important from the exam point of view, and I hope everyone is preparing the notes as well. So let's start the session. We are also going to start a foundation batch, and that batch is going to start from the 7th February 2022. In this batch you will get everything from mock test, ebooks, as well as the live sessions. And in this batch you are going to understand everything from the zero to advanced level. So this batch is very important if you are just a beginner, and if you just want to understand everything from the basic to advanced level. And in this batch you will understand everything that related to the exam point of view. Okay, in this batch you can also use the code Y422, and by this code you can avail 78% discount. So you can also subscribe this batch also. We are also just going to start a 3000 MCQs batch, and that batch is going to start from 26 January 2022. And the same code you can apply, that is Y422, and you can just avail a 78% discount. Okay, so let's start with the question first, and that is from the ratio analysis. Because quick ratio is given, current assets are given, current liabilities are given, and we have to calculate the value of the inventory. Okay, so in this question we have to calculate the value of the inventory by the informations are given for the quick ratio, current assets, and current liabilities. So as we all know that current assets, as I already discussed in my previous lecture, that is current assets are all the assets that can convert into cash within 1 year. Okay, and quick assets are the assets that more liquid in nature. All right. That means whenever you just need to encash that asset, you can just easily convert into cash. Okay, so that all known as a quick asset. So like I discussed in my lecture, that is inventory and prepaid expenses. Inventory and prepaid expenses are not a quick asset. Okay, so if we have to just calculate the value of the inventory here, so just understand that is inventory is a type of the stock. Okay, so inventory is a stock, and it is not necessary that each stock may sold, or say you find purchaser for that. So whenever you need them, and there may also be some stock that either on a manufacturing state, or say not finely prepared. So how you can just encash that? Okay, so you just cannot easily encash that stocks. So that's why it is included in the current assets but not a quick asset. Okay, so inventory is a type of the current asset but not the quick asset. So if here it is given that is quick ratio is given here, so we all know that that is the formula of the quick ratio is quick assets, and it is divided by the current liabilities. Okay, because why we just not included here quick liabilities? Because we assume that in liability case that that the company or say business have to pay all the liabilities. Okay, either it's a quick, either it's a current. Okay, the company have to pay all the liabilities, so that's why it is mentioned as a current liabilities. Okay, so in accounting there is they're just assuming that the quick and quick liability equal to the current liabilities. Okay, so that's why if I say that is the formula of the quick ratio, that is quick assets, and it is divided by the current liabilities. Okay, now if I say quick ratio is given here, that is 1.8, isn't it? It is 1.8 is to 1, and it's equal to the quick asset. So we have to just determine the value of the quick assets here. So the current liability is also given, that is 40,000. Okay, so if we have to just find out the quick assets from this, so we can just multiply into the 1.8, and we get 72,000 rupees. That is the value of the quick assets. Okay, so that means we have the just value of the current assets, and we also have the value of the quick assets. Okay, so quick assets here that is the value of the quick asset, that is 1.8 into 40,000, and that would be equal to the 72,000. And we also know that the value of the current asset, which is already given in the question, that is 90,000. And we know that if we have to just find out the value of the inventory, or say value of the stock, okay, and inventory or say stock is a part of the current asset but not the quick asset. So if we have to just calculate the value of the inventory, that means if we just subtract quick asset from the current asset, we can just determine the value of the inventory. Okay, so this is how we can solve these kind of the questions in the exam. Look, these kind of the questions is a very conceptual. Okay, so current assets, that is given a 90,000 rupees, and the quick asset, that is given the 72,000 rupees. Okay, and the answer would be that is 18,000 rupees. So this would be the value of the inventory. So this is how we can solve these kind of the questions. Okay, look, we know that if the we have to just calculate the value of the inventory from the given data, and we know that inventory is a type of the current assets. Okay, but inventory is not the type of the quick asset. We know that, that is inventory is a type of the current asset but not the quick asset. So if the current assets are the given, and from the current assets, the inventory and the prepaid expenses are the type of the asset that generally not acceptable in the quick asset. Okay, so if we just subtract from the current asset, if we just subtract quick asset from the current asset, we can find the value of the inventory here. So the value of the inventory would be, that is 90,000 minus 72,000, and that would be equal to the 18,000. Okay, so this is how we can just calculate. If you I just recommend you, that is please make the notes as well, because the sessions I have take, I already explained all the type of the ratio analysis questions in my previous lectures. You can also watch them. Okay, so now understand another question, that is related to the calculation of the interest. And here, that is the question, find the annual rate of interest using simple interest, and if the amount owed after 6 months is 55,000 rupees, and the amount being borrowed is a 50,000 rupees. Okay, so now we have to just calculate the value of the annual rate of interest. So look, in this question we have to find out the annual rate of interest. Okay, while datas are given for the 6 months, 6 months, that means half yearly. So basically 50,000 rupees is borrowed. Basically 50,000 rupees is borrowed, and 55,000 rupees it becomes after 6 months. So like 50,000 rupees borrowed and 55,000 rupees it becomes after 6 months. Okay, that means if we have to just calculate the interest amount, so the interest amount would be, that is a 5,000 rupees. Okay, and we all know that the formula of the simple interest, that is the simple interest, is equal to the principal into, that is the rate of interest, and we have to calculate the rate of interest, and the time period, that is 6 months. In the simple interest formula, that is p multiplied by r multiplied by t, and it is divided by the 100. So this t is in the years. Okay, so this t we just calculate in the years term. So if we have the given data for the 6 months, that means we have to just determine for the annually. Okay, say annually or say yearly. So it is also can be rewritten as a 6 by 12, and it is divided by the 100. Okay, so now if you're just going to solve these calculation, so you will get the value of the, like, just calculate this. So you will get the value, that is 20%. Okay, so from these calculation you can find the value of the rate of interest, that is 20%. Okay, either you can also solve by this method, that is if you find the value of the interest, that is 5,000 rupees. Okay, and you have to give this 5,000 rupees on the value of the 50,000 rupees. That means if we have to just give the value of the 5,000 rupees on the value of the on the borrowed value, that is 50,000 rupees, that means our interest would be, that is 10%. Okay, and this 10% rate of interest is we are giving in the 6 months. Okay, so for annually that would be equal to the 20%. So this is how we can solve. So you always the concept of including this question is because the data is given for the 6 months. Okay, and you will find these kind of the questions in the exam, like we have to calculate the annual rate of interest, and while the data is given for the half yearly. Okay, so you always have to understand that is simple interest, the formula of the simple interest. You can also solve by this, and here principal, rate of interest, and time period is given, and this time period is generally in the terms of the years. Okay, so if it is in the years, suppose that here it is mentioned that is 4 months. Okay, let's say suppose that if the amount owed after 4 months, so that means now we have to, if we have to just calculate the value here, so we can write here 5,000 equal to 50,000, that is principal, and we have to calculate the rate of interest into, not time period, if I say that is 4 months, suppose that, so we have to just write 4, and because we have to calculate for the annual rate of interest. Okay, so 4 and it is divided by the 12. Okay, so and it is multiplied by the 100. So this is how we can solve these kind of the questions. I think this concept is clear for everyone. Now another question that is related to the accounting standard, and look, the question is that is which of the following accounting standard relates to valuation of the inventories. Okay, so the answer is that is accounting standard 2. You know, accounting standards are basically accounting, if I say that is accounting standard, so accounting standard basically written policy documents. In simple term, if I say that is accounting standards are written policy documents, and accounting standard 2 related to the valuation of the inventories, and many times these kind of the questions you will find in the exam. Okay, so you know there are different types of the assets in the business. There are different type of the assets in the business. There are different types of the assets in the business, and one of them, that is a stock. Say stock or say inventory. Okay, means products are either in the form of the sale or say in the process of the such sale. So purpose of the accounting standard 2, that is to determine the cost at which inventories must be valued an asset in financial statement. So if I say that is the purpose of the accounting standard is to including in the account in the definition of the accounting standard. So to determine the cost at which inventories must be valued and an asset in financial statement. Okay, so this is a concept. This is the purpose of the accounting standard 2, and the valuation of the inventory is related to the accounting standard 2. Okay, I hope it is now memorized. Now the next question is which of the following accounting standard related to the contingencies and events occurring after the balance sheet date. Okay, so first understand what do we understand by the contingencies. So you know basically it is an event like emergency, and that may occur but it is not certain to occur. So it is an type, or say it is an emergency event. It is an emergency event, and that may occur, the possibility that may occur. Okay, but it is not certain, but it is not certain. Okay, so that is the known as a contingencies. And events like occurring after the balance sheet date. So just understand with the example. Suppose that if a debtor of our company, debtor, that means suppose that this is B and this is A, and this is suppose that this is me, okay, and this is my company, and this person B just purchased goods from me on credit. This person, this B, purchased goods on credit from me, and suppose that this person B just purchased goods or services on credit from me. So that means now this B would be known as a debtor of me, and I would be known as a creditor for them. Okay, so this would be a debtor. So suppose that if a debtor of our company, and debtor is a person who borrows goods or services on credit from us, and suppose that this person B failed to pay loan amount. Suppose that this person B failed to pay loan amount due to solvency. Okay, suppose that this person becomes solvent, and now he just failed to pay my loan amount. So this is the event, and this event is occurred after the balance sheet date. So that is known as a contingencies and events occurring after the balance sheet date. And this is related to the accounting standard 4. Okay, I hope it is clear for everyone. So what do we understand by the contingencies? Like emergency event that may occur, but it is not certain to occur. Okay, but the condition is that is it is not certain. This is also important. Okay, now next question is that is which of the following standard relates to the accounting for the government grants. So what we understand by the government grant, basically it is refers to the support given. It refers to the support given by the government to an enterprises, or say any business, or say any company. Okay, so what we understand by the government grant, that is support given by the government to an enterprises, business, or say company, and it may be either in the cash or kind of. Okay, so it may be either in the cash or the kind of. The just you have to understand what we understand by the government grants. So the government grant, basically it is a support given by the government to an enterprises, business, or a company, either in the cash or the kind of. So such grants are given for an enterprise to meet past or future compliance along with certain conditions. Okay, so if the question is that is which of the following accounting standard relates to the accounting for the government grant, so the answer would be that is accounting standard 12. Okay, so accounting standard 12 related to the government grant. Okay, and government grant, what we understand by the government grant, that is support given by the government to an enterprises and business or say company. Okay, so till now we just understand three accounting standards. So first we understand about the accounting standard 2, that is related to the valuation of the inventories. Okay, that is related to the valuation of the inventories. Accounting standard 4, that is related to the contingencies and events occurring after the balance sheet date. Okay, and accounting standard 4, that is related to the government grant. I hope that all memorized now. So 2, that is valuation of the inventory. 4, that is contingencies and events occurring after the balance sheet date, and accounting standard 12, that is related to the government grant. Okay, now understand next question, that is assuming that the current ratio is given, that is 2:1, and the sale of inventory at loss for cash. So what will be the effect of this transaction on the current ratio? So as we all know that the formula of the current ratio, that is current assets, and that is divided by the current liabilities. Okay, so if I say that is current ratio, we also can just say that current ratio is directly proportional to the current assets. Okay, that means if the current assets, if the our company's current assets increases, that means current ratio will also be increases. Okay, so if the current assets of our company will be decreased, that means our current ratio will also be decreased. So the question is, that is a sale of the inventory, and inventory is also a part of the asset. Inventory is also an asset, and or say inventory is also a current asset. Okay, so inventory, that means stock, so it is an asset, or say it is a current asset. Okay, so suppose that if the sale of the inventory at loss for cash, if the sale of inventory at loss for cash, that means cash also be a part of our current asset. And if there is a loss happened in the sale, in the selling of the inventory, or say in the selling of the stock, that means if that means that that would be deduction for our company's cash. Okay, say company's cash, or say company's capital. So if the selling of the inventory just happening at a loss, okay, if the selling of the inventory just happening for the loss, that means that loss will be the part of, because the cash is the part of the current asset, and that means our current asset just decreased. And if our current asset decreased, that means our current ratio will also be decreased. So the answer would be, that is the current ratio will be decreases. Okay, so this is how we solve these kind of the questions. Look, these kind of the questions is such a conceptual questions, and where you have to just follow the concept you learned. So if I say that is the current ratio, so we know that the current ratio is directly proportional to the current assets. And because cash is also a part of our current asset, and if cash is decreasing, that means our current ratio will also be decreased. So that would be the answer. So this is how we solve these kind of the questions in the exam. Okay, so that's all for this session, and I hope this lecture would be very useful for you. And if you are liking our content, please do not forget to hit the like button. So if you have not downloaded the Adda 247 application, just download this and subscribe the Officers Adda 247 YouTube channel, so that you can get notifications of the live lectures as well as the notifications of the important news. So thanks for joining me here, and thanks for watching me here, and do not forget to hit the like button as well.